Two funds, same promise on the label, weekly income, completely different beasts under the hood. On one side, AMDW, the Roundhill AMD WeeklyPay ETF, is basically a turbocharged AMD machine. Swaps, direct AMD stock, Treasury bills, and 2x leveraged exposure to the weekly price return of advanced micro devices. On the other side, EHCC, the global Ethereum covered call ETF, is an Ether income machine, mostly cash on the holdings page, plus a synthetic covered call strategy using US-listed spot and futures-based Ether ETPs with options written for premium income. So if you only look at the yield sticker, you miss the whole plot. AMDW shows 37%. EHCC shows 10%. Both pay weekly, but one has grown net asset value sharply since launch, while the other has seen NAV erosion. One had the bigger total return. One had the smaller drawdown. One is concentrated single stock leverage. The other is crypto-linked covered call engineering. This is not just a yield contest. This is an autopsy. Let's open the hood because AMDW and EHCC are not two versions of the same idea. They are two completely different income machines wearing the same weekly payout jacket. AMDW is the Roundhill AMD WeeklyPay ETF. It launched on July 24, 2025, and the core mission is very specific: provide weekly distributions and 2x leveraged exposure to the weekly price return of advanced micro devices, Inc., stock, ticker AMD. That phrase is doing a lot of work. This is not a broad technology ETF. It is not a diversified semiconductor ETF. It is not a basket of dividend stocks. AMDW is built around one company, Advanced Micro Devices, and it is not merely holding AMD 1-for-1. It is targeting 2x leveraged exposure to AMD's weekly price return. So plain English, if AMD is the race car, AMDW is trying to strap a modest booster rocket onto the weekly move. Not every day forever in a simple straight line, but around the weekly price return. That means the fund is built for a very particular type of exposure: concentrated, amplified, and highly path-dependent. The holdings show how this machine is assembled. AMDW holds advanced micro devices swap exposure at 76%. It also holds advanced micro devices, Inc., stock directly at 23%. It holds United States Treasury bills at 31%. And there is another AMD swap line, Advanced Micro Devices, Inc., swap gold L at 21%. That is the skeleton. Swaps are not decoration here. They are central to the machine. A swap lets the fund get economic exposure to AMD without simply buying every dollar of exposure as common stock. The Treasury bills act like collateral and liquidity ballast. The direct AMD stock gives the fund actual share exposure. Put those together, and you get a derivatives-heavy, actively managed fund whose universe is basically AMD exposure, and the cash-like instruments needed to support the structure. Now, how does AMDW manufacture income? The data tells us it seeks weekly distributions while delivering leveraged weekly AMD exposure. The important thing for viewers to understand is that this is not income in the old-fashioned sense of a utility stock mailing out a dividend from steady profits. AMDW's weekly payout is attached to an engineered exposure strategy. The fund can distribute cash from the economics of the portfolio, but a distribution from a high-yield ETF is not automatically a clean dividend. It can include return of capital, and it can interact with the fund's NAV. That is the trap with these products. Cash in your hand feels like victory, but if the fund is paying you from a machine that depends on a volatile underlying, you have to watch both sides of the ledger: the payout and the remaining asset value. AMDW's story is, give me leveraged AMD exposure, pay me weekly, and accept that the ride can be violent. EHCC is a totally different animal. EHCC is the global Ethereum covered call ETF. It launched on April 1, 2026, and it mostly invests in long ETH, short USD currency exposure. It is actively managed, offering Ether price exposure while prioritizing high-income potential and periodic distributions. But here is the key phrase: synthetic covered call strategy built on US-listed spot and futures-based Ether ETPs. That means EHCC is not simply a wallet full of Ether. It is not just holding ETH and sending you yield from some magical blockchain fountain. It is trying to create Ether-linked exposure through listed vehicles, then write options around that exposure to generate premium income. The holdings look almost strange if you are expecting a classic stock fund. EHCC shows cash at 78%, other payables and receivables at negative 0.75%, plus 3 call options and 1 put option. The fund writes for premium income. So what is happening here? Think of EHCC like a toll booth set up on a crypto highway. The fund wants exposure to Ether's road, but it also wants to collect tolls from option buyers. By writing call options, it collects premium today, but gives up some upside if Ether-linked exposure rips higher beyond the option structure. The written put option also brings in premium, but written options can create obligations and risk if the underlying moves the wrong way. That is the basic covered call bargain. You rent out part of your upside in exchange for cash now. It can feel wonderful in a sideways market. It can cushion some pain in a down market. But if the underlying asset falls hard, the premium may only be a seatbelt, not an airbag. And if the underlying asset rockets higher, the strategy may not capture all of that move because it has sold away some upside. So side by side, AMDW is a leveraged single-stock AMD machine built with swaps, direct AMD shares, and Treasury bills. EHCC is an Ether-linked synthetic covered call machine built with cash, payables and receivables, and written options around US-listed spot and futures-based Ether ETP exposure. Same weekly rhythm. Very different engines. AMDW is the sports car with leverage and one semiconductor stock under the hood. EHCC is the options booth collecting premiums on a crypto-linked road. One is trying to amplify AMD's weekly movement. The other is trying to monetize Ether-linked volatility. Both can pay, both can hurt, and the reason they hurt is completely different. Before we go any deeper, this video is for research and education only. It is not financial, investment, tax, or legal advice. It is not a recommendation to buy, sell, or hold either AMDW or EHCC. ETFs can lose value, including funds that pay large or frequent distributions. Always verify the current fund documents, prospectus, holdings, distribution details, and tax information, and consult a qualified professional before making any financial decision. Now let's talk about the part that gets everyone leaning forward. Yield. AMDW shows a headline distribution yield of 37%. EHCC shows a headline distribution yield of 10%. Both pay weekly. So if you are just sorting by yield, AMDW walks into the room wearing a neon sign. 37% versus 10% is not a small difference. It is the difference between that's high and wait, what is going on here? But that question is exactly the point. What is going on here? AMDW's 37% yield is tied to a fund that targets 2x leveraged exposure to AMD's weekly price return. The fund is not clipping bond coupons. It is not holding a sleepy basket of dividend aristocrats. It is built around AMD, a single technology stock, and it uses swaps and direct stock exposure to create amplified weekly exposure. So the yield has to be interpreted as part of a high-voltage system. You are not just asking, how much does it pay? You are asking, what kind of machine has to exist to make this payout possible? And in AMDW's case, the machine is concentrated AMD exposure with leverage. That can be powerful when AMD's price path is favorable. But it also means the payout exists inside a structure that can move sharply. A weekly distribution from a fund like this should not be mentally filed next to interest from a savings account. That is how investors get hypnotized by yield and forget the cliff edge. EHCC's 10% headline yield is lower, but its income mechanism is more familiar if you understand options income. EHCC seeks Ether price exposure and writes options for premium income. It uses a synthetic covered call strategy built on US-listed spot and futures-based Ether ETPs. The holdings show cash, payables, and receivables, plus 3 call options and 1 put option. The fund writes for premium income. That means EHCC is trying to turn option premium into distributions. Options buyers pay for the right to participate in certain price moves. The fund collects that premium. That premium can then support distributions, but it comes with strings attached. The classic string is capped upside. If Ether-linked exposure surges, a covered call strategy may not fully participate because it has sold calls. The other string is downside exposure. If Ether-linked exposure falls, the premium helps, but it does not make the portfolio immune. A covered call is not a force field. It is more like getting paid to wear ankle weights during a race. You collect cash, but you may not sprint as freely. Now compare the actual distribution trends. AMDW's first 4 distribution average was 94 cents. Its latest 4 average was 171 cents. That is a clear increase in the data provided. EHCC's first 4 distribution average was 19 cents. Its latest 4 average was 14 cents. That moved the other direction. So on yield level, AMDW is higher, 37% versus 10%. On recent distribution momentum, AMDW also looks stronger, 94 cents to 171 cents, while EHCC moved from 19 cents down to 14 cents. But the interpretation should be careful. A rising distribution is not a promise. A huge yield is not a guarantee, and a lower yield is not automatically safer. AMDW's larger payout comes from a more aggressive machine. EHCC's smaller payout comes from an options income machine tied to crypto-linked exposure. AMDW has been paying more and recently paying more per share. EHCC has been paying less and recently paying less per share. But in both cases, the only honest question is, what happened to the NAV and total return while those checks were going out? Because income without context is just confetti. Now we get to the body on the table, net asset value. This is where high-yield funds either prove they are holding together or reveal that the payout is coming with structural damage. AMDW launched with a reference price of $53.20. Its latest NAV is $103.01. Its NAV return since inception is 94%. That is not NAV erosion. That is NAV expansion. AMDW did not just pay weekly cash and slowly shrink in the background during this window. Its NAV moved substantially higher. That matters because a lot of income funds can create an illusion. They hand out cash, the investor feels paid, but the fund's asset value quietly melts. AMDW in this data did not show that pattern. The fund's AMD-linked, leveraged exposure performed strongly enough that NAV climbed from $53.20 to $103.01. Now, that does not make AMDW safe. It means the underlying path worked in its favor during this measurement period. A leveraged single-stock fund can look brilliant when the single stock behaves. But the same structure that helps on the way up can bite on the way down. The NAV result is impressive, but the machine is still aggressive. EHCC tells a very different story. EHCC launched with a reference price of $25.41. Its latest NAV is $17.98. Its NAV return since inception is negative 29%. That is NAV erosion. The fund paid weekly distributions, but the asset value declined. And this is the key lesson with covered call ETFs. Option income can be real, but it does not automatically stop the underlying from dragging the fund down. EHCC is tied to Ether exposure through a synthetic covered call strategy. If Ether-linked exposure is weak, the options premium can help, but it may not be enough. And if the strategy is selling upside through calls, it can limit how much recovery investors capture if the underlying rebounds sharply. So the NAV comparison is stark. AMDW. $53.20 launch reference price to $103.01 latest NAV, with a 94% NAV return since inception. EHCC, $25.41 launch reference price to $17.98 latest NAV, with a negative 29% NAV return since inception. AMDW held up better. Actually, held up is too weak. AMDW grew NAV dramatically in the data provided. EHCC saw NAV decline, but don't miss the deeper story. AMDW's NAV strength came from a fund tied to 2x leveraged AMD exposure. EHCC's NAV weakness came despite an income overlay designed to harvest option premium. That means the label covered call should not lull anyone to sleep, and the label leveraged single stock should not automatically tell you the result without looking at the actual underlying path. These are different risks. AMDW is more like riding a high-powered elevator attached to one stock. It can fly up. It can drop hard. EHCC is like collecting rent on Ether-linked volatility, but still owning exposure to the neighborhood. If the neighborhood falls in value, the rent checks may not save the property price. Now let's add the cash back in, because income investors do not only experience NAV, they experience NAV plus distributions. AMDW has paid cash distributions since launch of $38.18 per share. Its simple distribution inclusive return is 165%. EHCC has paid cash distributions since launch of $1.76 per share. Its simple distribution inclusive return is negative 22%. That is the cleanest head-to-head result in the whole dataset. AMDW did two things at once in this period. It grew NAV and paid a large amount of cash. The latest NAV is $103.01 versus a launch reference price of $53.20, and distributions since launch totaled $38.18 per share. That produces a simple distribution inclusive return of 165%. EHCC paid cash too, but not enough to overcome the NAV decline. Its latest NAV is $17.98 versus a launch reference price of $25.41, and distributions since launch totaled $1.76 per share. The simple distribution inclusive return is still negative 22%. This is why income autopsy does not stop at the yield label. A high distribution can be either part of a strong total return story or a shiny distraction from capital decay. In AMDW's case, in the data provided, the distribution did not hide a negative total result. It came alongside a very strong total result. In EHCC's case, the distribution did not rescue the total result. It softened the picture, but the distribution inclusive return remained negative. Mechanically, that makes sense. AMDW is tied to AMD's weekly price return with 2x leverage. If AMD's path is favorable enough, the fund can benefit heavily. The swaps and direct AMD exposure are designed to give the fund that amplified participation. If that works, NAV can rise even while distributions go out. EHCC is tied to Ether-linked exposure with a synthetic covered call overlay. The written options collect premium, but that premium is not unlimited. If Ether-linked exposure falls, the premium may only offset part of the damage. If Ether-linked exposure rises sharply, the call riding component can limit upside participation. That is the trade. Cash today, less open-ended upside tomorrow. So on simple distribution inclusive return, AMDW was stronger by a wide margin, 165% versus negative 22%. But the lesson is not big yield always wins. That would be the wrong autopsy report. The lesson is that the underlying engine mattered more than the payout label. AMDW's underlying AMD-linked leveraged exposure delivered during this period. EHCC's Ether-linked covered call strategy did not overcome its NAV decline. Same weekly schedule, same income marketing gravity, completely different economic outcome. Now let's talk about the part that usually gets ignored until it sends a bill: risk. AMDW's max drawdown was negative 48%. EHCC's max drawdown was negative 35%, so AMDW had the deeper drawdown. That fits the machine. A fund targeting 2x leveraged exposure to the weekly price return of one stock should be expected to swing hard. There's no broad basket here to hide behind. The fund trades around AMD. It holds AMD swap exposure, direct AMD stock, Treasury bills, and another AMD swap line. That is concentrated. And concentration plus leverage is not a pillow. It is a blade. If AMD turns against the fund, AMDW is designed to feel it. The same structure that can help NAV surge when the underlying path is favorable can amplify pain when the path turns ugly. A negative 48% max drawdown is not a rounding error. That is the kind of move that tests whether an investor actually understood what they owned or only understood the yield. EHCC's max drawdown was negative 35%, which is smaller than AMDW's, but still severe. Let's not pretend negative 35% is gentle. That is still a large peak-to-trough decline. EHCC is tied to Ether exposure, and Ether-linked exposure can be volatile. The covered call structure can collect premium, and that premium can cushion some movement, but it does not eliminate downside. Selling options can create income, but it does not turn crypto-linked exposure into a bank CD. The bigger twist is that EHCC had the smaller max drawdown but the worse NAV and simple distribution inclusive return in the data provided. That is important. Risk is not only how deep was the worst drop. Risk is also, did the fund recover? Did the income compensate me? Did the NAV keep bleeding? Did the payout trend improve or deteriorate? On distribution trend, AMDW improved. First for distribution average, 94 cents. Latest for average, 171 cents. EHCC declined. First for distribution average, 19 cents. Latest for average, 14 cents. So AMDW had the scarier drawdown but stronger NAV performance, stronger total return, and rising recent distributions in the provided data. EHCC had the smaller drawdown but weaker NAV performance, weaker total return, and declining recent distributions. That gives us a more nuanced risk picture. AMDW, risk is volatility and concentration risk. You are exposed to one company, AMD, with 2x weekly leverage. The fund uses swaps, which adds derivative structure. It pays weekly, which can make investors focus on cash flow while underestimating the violence of the underlying exposure. The danger is not subtle. It is printed right into the design. EHCC, risk is different. It is crypto-linked exposure plus options overlay risk. The fund seeks Ether price exposure, but prioritizes income using a synthetic covered call strategy. That means the fund can collect premiums but may give up upside. And if the underlying exposure falls, the premium may not be enough. The declining distribution trend from 19 cents to 14 cents also matters because it shows the recent payout level was lower than the early payout average in this dataset. AMDW is the sharper knife. EHCC is the padded glove that can still break your nose. If you only judge by drawdown, EHCC looked less extreme, negative 35% versus negative 48%. But if you judge by what investors kept after NAV changes and distributions, AMDW was far stronger in this period. That is the uncomfortable truth. The fund with the worst drawdown delivered the better outcome because its underlying machine worked during the window measured. The fund with the smaller drawdown still lost ground overall. That is why risk cannot be reduced to one number. You need the whole autopsy: structure, NAV path, total return, drawdown, and distribution trend. So what is the verdict? AMDW and EHCC are not interchangeable income ETFs. They are different tools for different jobs, different risk appetites, and different market views. AMDW is the high-powered AMD machine. It has the higher headline distribution yield at 37%. It pays weekly. Its expense ratio is 1%. Its assets under management is $89 million. It launched with a reference price of $53.20. And its latest NAV is $103.01. Its NAV return since inception is 94%. It has paid $38.18 per share in cash distributions since launch, and its simple distribution inclusive return is 165%. Its first four distribution average was 94 cents, and its latest four average was 171 cents. That is the attractive side of the autopsy. The dangerous side is the structure and drawdown. AMDW is an actively managed fund targeting 2x leveraged exposure to AMD's weekly price return. It uses major AMD swap exposure, direct AMD stock, Treasury bills, and another AMD swap line. Its max drawdown was negative 48%, so the strong return came from a machine that can cut deep. This is not conservative income. This is concentrated, leveraged, single stock exposure wearing a weekly distribution suit. EHCC is the Ether options income machine. It has a lower headline distribution yield at 10%. It pays weekly. Its expense ratio is 0.75%. Its assets under management is $1 million. It launched with a reference price of $25.41, and its latest NAV is $17.98. Its NAV return since inception is negative 29%. It has paid $1.76 per share in cash distributions since launch, and its simple distribution inclusive return is negative 22%. Its first four distribution average was 19 cents, and its latest four average was 14 cents. EHCC's mechanism is more like a classic income overlay. Get Ether-linked exposure through US-listed spot and futures-based Ether ETPs, then write options for premium income. The holdings show cash at 78%, other payables and receivables at negative 0.75%, plus 3 call options and 1 put option the fund writes for premium income. The trade-off is that premium income can help, but upside can be capped, and downside can still hurt. Its max drawdown was negative 35%, less severe than AMDW's, but the NAV and total return picture was weaker in the data provided. So if the question is, which fund had the stronger numbers in this dataset? AMDW clearly did on yield, NAV return, distribution inclusive return, and distribution trend. EHCC had the smaller max drawdown and the lower expense ratio, but weaker NAV and total return results. But if the question is, which one should someone buy? That is not what this channel does, and that is not the right frame. The better frame is, what tool are you actually looking at? AMDW is a leveraged AMD exposure tool with weekly distributions. It depends heavily on the path of one stock and can swing violently. EHCC is an Ether-linked covered call income tool. It depends on crypto-linked exposure and options premium, and it may trade upside participation for cash flow. Different tools, different trade-offs, different failure modes. The big takeaway is simple. Weekly income is not a strategy by itself. It is just the sound the machine makes. Before anyone gets impressed by the payout, they need to understand what the fund holds, what it trades around, how it manufactures distributions, what happened to NAV, and whether total return actually backed up the cash flow. Research only. Verify the current fund documents. And never let a yield sticker do your thinking for you.